أما الآن سيداتي وسادتي سنكون مع ورقة العمل الأخيرة لهذا اللقاء والتي تدور حول آلية التفاعل مع المستثمرين من خلال تنظيم يوم المستثمر، بالإضافة لكيفية الحصول على ردود الفعل من المستثمرين. يقدمها السيد بوبي مورس، فليتفضل مشكورا.
I have just exhausted my entire Arabic vocabulary. But thank you very much for spending your precious time this morning and this afternoon. I hope my presentation will be even as half as illuminating as the presentations before me. I think I'm going to face some quite hard questions by the time I finish this through Angus, who is previously an analyst at a top bulge bracket bank. And as you'll see from my presentation, I think Neil will laugh at the enormous amount of content that I put into my presentation, which makes it almost entirely unreadable. Anyway, here goes. I'm just going to touch a little bit on who I am and why I do what I do. UK Financial is a joint venture with Buchanan, which is based in London, and Helen Knowlton, which is a big network throughout the world. The joint venture is a focus very specifically on the Middle East. And what we're trying to address is the amalgamation of corporate communications with the importance now of financial communications, and helping companies to reach out to international capital markets in order to help the financing of those businesses to grow. I myself am a reformed investment banker. I used to work for in corporate finance at a company which is now part of Investec, which is a big South African investor relations at BNP Paribas, which is a global bank. And I got into the dark side of communications way too long ago, about 15 or so years ago. And the kind of stuff which I do is a mixture of investor relations through to advising companies on how to deal with crisis management, how to deal with communicating mergers and acquisitions, fundraisers, and other aspects which are of significant importance to a company development. I'm not going to wax too lyrical on this slide. I just want to really kind of summarize that. I've been aware of the sophistication that many Palestinian companies have, in view that a few years back in 2011 and also in 2013, we had the pleasure of hosting a group of Palestinian companies who presented to UK institutions and emerging market global investors in London. And today, in terms of the people here who I've spoken to, I don't really need to try and sell the dream of investor relations. I think it is very well understood already. But I'm going to go into many more of the components on how you can use investor relations in order to be able to attract those potential investors, which Neil and Angus has rightly said are incredibly hard to be able to get hold of. I think we need to just step back one step before I go into the actual tools and try and get some kind of understanding of what the challenges are out there at the moment. Emerging markets. This is a slide on emerging markets. To try and encapsulate what we're dealing with here by looking just at the top 500 global asset managers alone. They manage about $70 trillion worth of assets. Within that 70 trillion, we are talking about 5 trillion or 4 to 5 trillion of which is invested in what are deemed to be emerging markets. Now that is a big number. 4 or 5 trillion dollars worth out there in the market, looking to go into fast growth markets. It looks like an extremely rosy situation. But the reality is that this money, or this finance, is concentrated into very few hands, and usually outside of the regions where that money is going to be deployed. I put here a graph which demonstrates the MSCI Emerging Market Index versus the S&P 500, the US indices, on the basis of book value, and how there's been a significant departure since 2010 in terms of allocation. It's important to work out that in terms of all that money that is out there, a lot of that money has been allocated to developed markets and increasingly less to emerging markets, principally because of what's happened internationally in terms of the growth of the US market, the increase in volatility and uncertainty in emerging markets, and so forth. And I'll come into very specific reasons as to why. But that sets the scene as to where we are from an emerging market investor perspective. So let's have a look at the trends. The reason for emerging markets becoming less or underweight with these massive global fund managers is principally because of the strength of the US dollar. A lot of the debt which is issued in emerging markets is still dollar denominated, and subsequently, when the dollar strengthens as it has done over the last 3-4 years, it has made debt more expensive in many of these emerging markets. So out of the 2.6 trillion of bonds issued in 2014, 75% of that was denominated in US dollars. We've also seen a collapse in commodity prices, which has been a reaction effectively to the slowdown in the Chinese economy as it's moved from a construction type of business or of economy into a more consumer-led, and that has involved a certain amount of pain. And this has resulted in a significant amount of outflow of funds from emerging markets. However, and this is where I think we've actually reached a really interesting point now in time, where emerging markets are concerned. There haven't really been, during this last period, a significant balance of payment crisis like the types we used to see in the early 2000s. The IMF haven't had to step in and bail out any significant economies during that time. Corporate defaults on bonds over the course of the last 3 or 4 years have not been abnormal. There's been relatively low, and there's been no real outstanding situations from an emerging market perspective. There have only been 2 sovereign defaults, effectively, one being Greece, which is technically an emerging market, and the other Argentina back in 2014. The irony of which, in terms of looking at where things are today, Argentina only announced last month the raising of over $16 billion in a high-yield bond, which, if they wanted to, they could have raised $70 billion. Such was the demand. Shows how short memories can be. But the fundamentals are the real key thing about emerging markets. There is less debt in emerging markets account for around 21% of world global debt, yet account for 57% of its GDP. The difference between emerging markets and developed markets in terms of their GDP growth, that's called the GDP premium, is beginning to increase in favour of emerging markets far faster than it has done before for the last 5 years, and that's a very significant indicator. Bond yields now in emerging markets are higher than they were in developed markets back in 2006, when, you may recall, the Fed were paying between 5 and 5.25%. So this spread of bond yields, which are emanating from emerging markets, is showing a really strong sign of an opportunity to invest. The other aspect, which I think is really critical to all of us, is that the dollar is now, for the first time for many years, beginning to show signs of weakness, and also oil, for instance, as a commodity, is no longer that one-way bet that it was last year, where no one could really see the floor of it. We're now beginning to see at least some kind of appreciation in oil. So it's all very rosy in the garden of emerging markets. Well, let's have a look at this slide. I mean, you probably can't see this. I can barely see it. It's so small. But you'll be familiar with MSCI, Emerging Markets Indexes. But if you have in your mind that 70 trillion of funds which are under management, 65 trillion of that. 65 trillion of that is just in there. The other 5 billion is spread across all of this, of which more than half of that 5 trillion is just focused on this small grouping alone. Why is that relevant? Well, the relevance is kind of showing that in terms of all that money that's out there, trying to attract money for these kind of markets is a gargantuan task when compared to this market, let alone the emerging markets index. And if you actually look at some of the constituencies of the emerging market index, 24 or 25% of that is China alone. And you've got about 8% of that is India, about 7% of that is Brazil, Russia's about 4%, so just between 4 countries, and this grouping alone takes up over between 40 and 45% of total assets invested. So the bigger ones take all the money, the smaller ones get far less. And that is the challenge which we are facing today, ladies and gentlemen. The other issues which, and I've covered some of this already in this particular slide, but some of the bigger issues are about liquidity, about how investors are able to come in and take a stake in some of the businesses which are fast growing. Liquidity is key. It's all fine making an investment, but can you get out? And this is particularly an issue when it comes to smaller companies, which are, and the purpose of this presentation today is to try and explain how you can maybe overcome some of those challenges. And that is going to be through an investor relations program. The key, from my perspective, is in a good investor relations program is how do you make yourself relevant to a particular investor. Angus has come up with some very good examples, some good IR and some bad IR. So this next part of my presentation is really going to focus on the tools that you're going to be able to use in best practice financial comms, investor relations. Neil touched on his firm's view on what best practice is, and I'm pleased to say that a lot does cross over with what I've put up on this screen, if you can read it. But basically, they're the five C's, which are the main constituents through the middle of this award, what I would see as best practice. The first C is channel of communications. Know who your audiences are, who are relevant to you, and through what channels you need to go through to reach them. That is a fundamental start. The second C is credibility. Investor relations, at its heart, is basically building your brand in capital markets. That brand is your reputation. And your reputation in a capital market environment is set by the expectations that you provide to the market and your ability to deliver on those expectations. If you're able to deliver and maybe even exceed those expectations, your credibility, your brand, or the value of your brand should go up. Clarity is the third C. A common mistake, and I think Neil covered this very well, is to be overcomplicated in the messages that you are saying. It's very, very important to distill exactly what you do, how you do it, for whom you do it, and what you charge for it, whatever the business model might be, but to make it as simple as possible. We're living in a time now where people are time poor but cash rich, so it's really important for you to be able to make it really stand out. Consistency is the fourth point. Business models will change. Companies do adapt to various situations which they have to go through during the course of their evolution. But the consistency of your message, not just in terms of the strategy of the company, but who you're saying and who you're communicating to, whether it is the financial press, whether it's the financial analysts, whether it's institutional investors, whether it's through any of your other government stakeholders, etc. You have to be consistent. That consistency will prove very valuable to you as you grow as a business. And the fifth and final C is continuity. Investor relations is not a silver bullet solution. You don't just shoot it once and then you've solved everything. It is something which takes a certain amount of time and commitment and belief to do, and make sure that what you're doing from an IR perspective, you build on and continue through the life of the company. Right, this is where we go a little bit more into a deep dive on who your capital audiences are. I start off, obviously, the most important, which are the investors themselves. These are the guys and girls who actually put the money into your companies. I've split this into the types of investors that there are, the approaches that they have, and the types of style of investment portfolio that they run. This is incredibly relevant to what you have to do as a company in terms of working out which of these groups and what combinations of the types and approach and style fits with your business model. You can spend a lot of time meeting the wrong people and not getting anywhere. If you're a company which is reinvesting all your profits into growing the business, you don't need to go and see a company, a fund manager who is focusing on yield return. So anyway, I'll go straight into the different types. You can split that into two. You've got the retail investors. We're all very cognizant of retail investors and how they operate. And I think, in terms of the retail investors, they are extremely important for a number of different types of companies, but particularly smaller companies, because a lot of the chatter and a lot of the investment decisions are sometimes made by what goes on in the media. But the retail part is an important part. But I'm really going to focus on the institutional side. These are the guys who you necessarily kind of want as a long-term investor. These are the people who will help finance your growth going forward. So on the institutional side, we have discretionary private client brokers. That's the PCB reference here. These guys are people who run money on behalf of high net worth individuals and make investment decisions on their behalf. You have the mutual funds, which are you'll be more than familiar with those. Those are huge pooled funds run by a few fund managers, but involved in assets, not just simply equities, but it also includes bonds, money instruments, cash, etc. Hedge funds. I won't go into detail on hedge funds, but if any of you do have a couple of hours to spare any time, do watch the film The Big Short. It's very well explained as to how that works. But don't be frightened again of hedge funds. Their whole issue is about absolute returns rather than relative returns. When I say absolute, that is, they have to have an alpha outperformance going up entirely rather than trying to beat an index. Because these are the guys who are able to actually make money. The main difference really between hedge funds and mutual funds is that hedge funds can make money when the markets are going down. So they bet against it. The pension funds are the long-only funds, of which certainly our market back in the UK and the US are probably most famous for. These are investments made by companies not in a 1 year, 2 year horizon, but for 3, 4, 5, maybe 10, in some cases longer investment horizons, where they feel that by providing enough mixture of different types of businesses, they can overcome volatility by looking at the long term. And you've got obviously index and tracker funds, which are passive funds, which just simply invest in the index. And I'll come back to this when the importance of the MSCI indexation is very relevant. And then obviously you've got things like sovereign wealth funds, which is where countries are reinvesting or investing their trade surpluses into potential opportunities. Usually in the developed markets, but increasingly now looking at emerging markets. I'm not proud to say that here, that me being British, we don't have a sovereign wealth fund, because I don't think we have ever, in the last 10 years, generated a trade surplus. So, and then obviously the next sector beneath that is private equity. Private equity tends to be a lot more off-market, and but increasingly we're seeing private equity begin to appear in listed entities, particularly looking at the real value opportunities out there and taking companies private. So those are the types of institutions that are out there. They tend to have two very distinct approaches. There's the active approach, which is much more stock picking, stock selectivity, trading on volatility, looking maybe at more higher risk type profiles of businesses. These kind of companies, I think, are the ones which audiences such as this need to be. They like meetings. They have to see management eye to eye, and they like regular meetings. And you've got the passive funds, which are you'd be lucky to meet anyone from a passive fund. Sometimes there isn't even a fund manager. It's a computer that does it. But these are more the index-related funds. They like very strong diversification in order to smooth out that potential risk. They don't like meetings. I think the important thing here now is also to look at, when you're looking at institutions you want to target, do consider what kind of style of investment they have. Some of these funds are very clear as to what style they have. So just going through the list, I won't touch on all of them in any detail, but the growth style of investment is really looking at companies which are fast growth, but have been somewhat under the radar. Value investors are looking at companies which are cheap or have become cheap very suddenly, yet their business models remain intact. The CAN SLIM style, it's an acronym which I'll be very quick on, but the C stands for current quarterly earnings, which have significantly overshot the market. That's the first thing they'll tick and get their attention. The A is for annual results. Is that company performing above market consensus on its annual results? The N stands for new, which are new products, new management, a new event situation, which can draw people's attention to that. Going on to the slim part, The S stands for small, but small supply, i.e. small amounts of competitors in a fast-growing market. That is a key issue. The L is for leaders over laggards. Are these companies innovative enough to be able to be seen as market leaders? And the I bit I find the most interesting, really, is what is the investor base of that company? I think you have a lot of fund managers out there who like to say that they are brilliant at their analysis and that they're able to find these amazing companies, but 9 times out of 10, these guys are following the herd and trying to get onto the heels of people who've made the stock pick. And that is a very important aspect, particularly when you're dealing with an illiquid market or a liquid company. If you're able to get someone who is well known for that particular style, you will begin to attract the attention of other institutions straight away. And the end is market direction, which is more of a quantitative analysis. Yield and income is quite a defensive investment model, which is really focused on dividends and yield. And then GARP. GARP is growth at a reasonable price, which is looking for companies which have been completely missed by the market, which have continued to grow but remain below the investment horizon. So it's quite complicated, but when looking to target very specific institutions, make sure you know who they are, what their approach is, and what style of investing they do. I've actually put up here some of the investors, or global investors, who have invested or are invested in Palestinian companies. This is by no means an exhaustive list. It's just a small list that I've been able to find. But it is very encouraging that you have got companies such as BlackRock. BlackRock is the biggest asset manager on the planet. It manages over $4 trillion worth of assets. And for them to have an exposure into a small market like Palestine is indeed encouraging. Up there, you can read that list ad nauseam, but JP Morgan and also some of the bigger regional players such as EFG, Hermes, etc. It is encouraging. I must stress that quite a lot of these fund managers are more of the passive and indexed element, so they are not stock picking per se. The interest here is that, from what I understood last time, that the Palestinian stock market is going to move from that MSCI banding from standalone to frontier later on this year. And this may well have an impact, a positive impact, in terms of weighting that is allocated to the Palestinian market. Even though Palestine probably accounts for a point of a percentage in terms of the global market, even just the slightest change in terms of that allocation and weighting could make a difference to those companies which are included in that index. I think that the companies which are in that index still remain very few, but it's going to be an important step in the right direction. So I've covered the investors. Now let's look at those people who can influence investors. The first group I would venture to say would be analysts, which Angus was a leading one in the city, and economists. Now, the purpose of sell-side analysts is to write research on companies and recommending whether those companies are worth buying, selling, or holding. But that's the obvious surface thing about what analysts are about. Analysts at these banks are there to also make money for the bank. And they do that particularly in 3 different ways. The first is by making that recommendation, their sales teams then get onto the telephone and try and generate some trade, and they get commission by doing that trade. The second way that they're making money is by attracting companies to become clients of that bank. They then pay a retainer, and they get all this wonderful advice and research going forward. The third thing, which I haven't put on there, is that quite a few of these banks, these analyst banks, are being paid by fund managers, particularly in sectors where those fund managers are weak. They will pay a retainer for that research. I'll give you a bit of an anecdotal story. A good friend of mine is a fund manager at Fidelity in London, who looks after a global fund. I asked him over a couple of pints one evening about, so how do you choose the analysts who you pay? And he said, well, it's very easy. I only pay 3 analyst houses. The first 2, which are rated on Excel at number 1 and number 2, who are the absolute best in their field. And the third is absolutely the worst that I can find. So why on earth are you doing that? Why the third? Why are you paying a monkey, to give you poor advice? And his answer was, well, basically, as long as I don't have any stocks that guy has picked, then I'm absolutely fine. So analysts are important. They give a view, they give a sentiment, they give a deep insight into how a company works from a financial perspective. The economists are, well, not equally as important, I think are important to factor into the audiences that you have to communicate to. Economists help fund managers in terms of their allocation of funds, which they allocate to any particular sector or any particular geography. And those economists usually sit in their ivory towers in their bank, making views upon those sectors and those areas. I think in terms of having only spent a brief amount of time here and having felt the energy and the will here to for companies wanting to expand and become bigger, an economist would do a damn good, do himself or herself a great favour coming here and understanding a little bit more about what this Palestinian market is about. So I've listed up there just a number of some of the bigger banks who cover the region as a whole, as well as some of the more indigenous ones throughout the region. And the key, I think, over the next year or so, is to get Palestine a little bit more better known among some of those brokers. Right, these are the tools I'm going to go through. But before I jump into the extraordinary fun that international roadshows are, I've got to make a couple of comments on news flow. Hamel rightly picked up on news flow as whether it's an important thing or not. My view is that news flow is the bloodline of your company. It's a question of when you choose to follow up and make that emphasis. The news flow makes you relevant to those institutions which you've been trying to target, which I highlighted on that matrix early on. And social media can also be an important part of exactly how you communicate. It's got to be back into that kind of consistency. All this has all got to be in place before you start your roadshow. So the step 1, though, is identifying which investors you want to have on your client list, on your shareholder register, and which territories they are. Now, life has moved on a bit over the last few years, and identifying existing shareholders is obviously the first step, and identifying potential shareholders who are invested in your peer group is the next step. But there has become a lot more of a science to it than it was before. There are a lot of shareholders out there who have spent quite a bit of money and effort in hiding who they are. So trying to actually nail down exactly who those people and who those funds are is the first step. The next step is have a reason to go on your roadshow. Don't simply roadshow for the sake of roadshowing. Usually, it tends to be a results-driven exercise after your full-year results or half-year results, maybe, or after a transaction, whether it be a fundraise or whether it be an acquisition, a spin-out or an IPO of an underlying business, or even indeed the completion of a big restructuring. The step after that will be then to make sure that you get your marketing collateral absolutely right. I'm not going to wax lyrical on that. Neil has done a tremendous job in highlighting that. But getting your presentation right is one thing. The other is rehearsing that presentation and being completely prepared in terms of the likely questions that you're going to be asked during the course of that roadshow. I can't emphasise enough how much importance first impressions count, particularly when you're dealing with these institutions who are very time short. Another aspect in terms of getting yourself noticed will also be how you can actually use the media. And when I say media, I'm talking about the financial media. And that'll range from anything from Bloomberg, Dow Jones, through to Financial Times, Wall Street Journal. The financial pages and the financial media, which tends to get consumed by institutions. If you're able to raise your profile ahead of a roadshow, it might actually flush out one or two more institutions who might want to talk to you. So roadshows is one way. Capital markets days, a few definitions of this, but capital markets days are much more deep dive experiences for analysts and institutions when they come to meet companies. This is really for companies who have already started to develop a following and then are looking to try and deepen and expand that following. And they tend to be much more technical. It's not the kind of presentation that you would have for an annual results presentation per se. It's much more strategic about a particular part of the business and a particular part of the growth message that the company wants to do. And usually you will have possibly the chief exec or a finance director present, but you're getting the next tier of the senior management telling the capital markets about how they're trying to build that particular part of the business. This shows the depth of the business and the sophistication of the business, and the ability to communicate on that is a really important aspect to also consider. I've put some examples here of capital markets days which we've done recently. The one on the far left, the company you've never heard of, is a company called Meggitt. It's an aerospace and defence company. It's a market cap of about 5 billion, and obviously it's very well followed. But they did a capital markets day just last month, as they had acquired a polymer business, which was an add-on to a part of the business that they're in. But it was effectively a new business. And analysts and investors spent a day down in Dorset looking at that business. This one, which I'm going to use this much more as a reference, which sums up what IR can do, is a company called Centamin. Centamin is the only listed company in London which gains 100% of its revenues from Egypt. It's a gold mining business. And they did a capital markets day for the first time last year on the basis of the underground mine which they were developing in southeastern Egypt. This one over here is a smaller company in the oil services space, and their capital markets day was very specifically of how do you make money if you're an oil services company working in an environment where oil is collapsing. And I'll show you some of the results from that in a moment. The third tool, I mentioned this a bit earlier, we've done this before with the Palestinian Stock Exchange a few years back, are country and sector seminars. It goes on the theme of what Angus said earlier, where pooling some of your resources and having a number of companies come to a capital market is actually a very good idea, because a group of companies, all from a variety of sectors, will attract a range of institutional investors and add some momentum to it. Now, you've got the presentation hopefully somewhere that I can read that, but we've done this with, this one here, was Egypt, the Egypt Capital Market Day. There's the Palestinian Capital Market Day we did a few years ago. This one here is Qataris, but basically a range of different Qatari companies. Saudi Arabia, obviously. And another aspect which can also work very well, which doesn't have to be country-centric, is sector-specific. So this Capital Markets Day was focused on Middle Eastern banks. We had a range of Middle Eastern banks from a variety of different countries in the Middle East. That's a good. We tend to use the London Stock Exchange for hosting, and it can be a very effective way of bringing the institutional investor horses to water. The way that it works there in the morning, you have a group, you present 20 minutes, 25 minutes maximum to a broad audience during the course of the morning. There's a networking lunch, and then after that there's a series of one-on-ones, which would be almost a bit like speed dating. The meetings are kind of half an hour, 45 minutes, and you do one after the other, after the other, and after the other. It's a very effective way of at least getting your name and brand in front of some of these big institutions. Angus touched on this earlier. If you can get yourself into some of the big investment banks who regularly do sector presentations, and the reason why they do sector presentations is that they like to demonstrate to their investing audiences, or investing clients, that they are specialists in a particular sector. So getting you along to these events is very much value added. They work along the same basis as the country seminars that I pointed out earlier. But the banks do tend to favour their own clients. But they do like having companies who are outside of their own client base, because at some stage, and maybe someday, they might be able to pick up that company as a client, particularly if they're looking at raising money or doing a restructuring or whatever they may be doing in the capital markets. That is a good, that's a very good way of getting in. And the key is knowing who those banks are and when they are doing those, conferences and where. Any good consultancy in investor relations will be able to tell you. If you think going on roadshows, talking to investors during capital markets days, doing all these things is revealing and difficult, well, site visits is the equivalent of bringing people into your very own house. This is probably the most intensive way of being able to try and get people interested in you. Go back to my original point about people being very time poor but cash rich. If you've managed to get an investor or analyst interested enough where they're going to spend a day, 2 days, maybe 3 days coming to see you, it depends obviously how accessible the business is. Not just see you, but also come see your operations, see how you do things, meet all the senior levels of management, and get a real good feel as to what the company DNA is. They're going there specifically to buy your shares or cover your shares. They're not going to spend 3 days just for the sake of spending 3 days. This obviously has a very important role when it comes to things like mining or oil and gas to actually show that there is something there, but also with manufacturing businesses and so forth. Obviously harder to do when it comes to financial services companies or necessarily internet technology companies. But if you're able to bring these horses to water and let them in effectively into your home, that is as great a transparency as you can probably do. Okay. I'm going to wrap up really quickly. Sentiment was the example that I used in terms of doing investor relations. Sentiment got incredibly hit by the volatility that happened in Egypt a few years back, and over that period, as an investor relations consultant, we've been spending our time trying to change that shareholder base, and we've done that by using all those tools which are highlighted earlier. I'm happy to talk about how we did this, but Sentiment now is the highest rated stock in London as a gold company, and it still has 100% of its revenues coming out of Egypt, which has still got a big job to do in terms of convincing the investment community in London that it's a good place to have your money. Cape, again, oil services, they've gone through the mangle. Well, the sector has, but they managed to keep their share price flat, while others have completely lost their value. It means that they can now do acquisitions which are accretive. And having used site visits and capital markets days, it has made a complete difference to how they've been perceived. The final tool, shareholder meetings, AGMs, EGMs. These are quite perfunctory things in terms of their businesses, but in terms of what they try and do, I urge you to use these kind of platforms to be able to say something different, say something which is interesting, allow the management to really show what they've got in terms of enforcing their messages. This is the measuring part. Does IR actually work, and do I actually need to pay for it? Well, don't pay for bad IR. It's not worth it. If you actually do want to make a return, IR is actually a profit centre. I say that with some incredulity, but if you think about it, if you have IR which works and you get your share price going in the right direction and you have a valuation which is realistic, the cost of you raising money will be less. Ditto, the cost of raising debt and having debt will be less if you are a highly regarded company. If you're highly regarded, you get rated by Moody's and Morse and these kind of guys. If your rating is high, your cost of capital is less. Now I've put on this slide just a few tangible and intangible aspects of being able to how you're able to measure investor relations. I think those who are interested in this room who want to know how to actually implement that, I'd be more than happy to talk over lunch. Once you've actually got the metrics agreed, then you've got to implement those, and you've got to be regular. You've got to make sure the metrics stay the same, otherwise you can't benchmark, and that is absolutely essential. My last piece is feedback. Feedback is, we move from quantitative to qualitative by actually talking to the people who you have met and returning to that on a regular basis. Will you be able to know whether your investor relations program is working or not? There are many different ways of trying to get feedback. The best is literally talking to someone over a telephone or face-to-face, rather than filling in just a questionnaire. The capital markets audit is a very detailed piece of work, which I can also talk to anyone who's interested about after, during the course of lunch. So, in summary, I'm delighted to hear I've got to that point. IR is not just simply about doing roadshows, putting out the odd press release now and again. It's become much more important with less and less fund managers managing more and more money. There's serious ramifications for smaller companies who aspire to become mid-cap and large-cap companies, in order for them to be able to attract some of these funds. I think there is very little doubt that if you have two comparable companies, comparable financials, comparable growth prospects, I think the one with the better investor relations program is much more likely to attract capital. I think also with IR becoming more and more interwoven with the corporate identity of any business, IR is not only a necessity in attracting long-term investors, but also is a fundamental point of a company's DNA. And with that, I'll hand over to the floor.
I'm curious about the issue of the analyst work.
Yeah.
And I think in Palestine here, and maybe in the Middle East in general, we lack this component. My question to you, how can you ensure the neutrality, the impartiality, the objectivity of the analyst in the eyes of the investors, given the fact that there is assumed perception of conflict of interest because of the fact that they are paid by the company itself? What kind of story would you sell for an investor that the analyst has its own credibility to an extent that those investors may take action accordingly?
I think in the first instance, the analysts that I'm referring to are ones which you're not associated with. You're not at that bank. So if you've got Goldman Sachs, who are your bank, the research that comes out of Goldman Sachs, I think you're absolutely right, will be not taken particularly seriously because of the conflict of interest. The value comes in getting a broker which is not involved with your company per se. It comes up with independent research, and the reason why they're writing on you is because they think this is a great idea. I can make some of my own institutional clients some money by recommending this. Secondly, but also behind their minds, is that if they get that call right, even though they're not making any money out of it per se, because liquidity is tiny, they can't get commission, they haven't got you as a client. But if they call that right, they're not frightened about coming forward about how brilliant they are. They will say that I called this right, and this is the next issue that I've got coming up. Will you, fund manager, buy some of my client stock in this share issue? It's about getting the right person in at the right time. And you're right, absolutely, about in terms of analyst coverage in Palestine. I haven't been able to find any analysts in any of my brief research that I've done before coming here today. But there are, let's use the banking industry, the banking sector, for example. There are a number of analysts based in Dubai, in Manama, in Cairo, who don't cover just banks from those particular countries, but the banking sector per se. And if I'm only using the banking sector as an example, and if there's a bank or a series of banks here who are relevant to some of the banks they already cover, but are trading at half book value, for instance, compared to the companies that they already cover, it's a great opportunity for them to come here and have a look at those banks and then start recommending them, particularly if the mothership, the firm above them, is also having aspirations to try and attract the attention of not just Palestine, but also the Palestinian diaspora, who also bank with many of these global banks. So it's trying to get independent analyst research is extraordinarily difficult, and it's really hard for smaller companies. It's much easier for larger companies. It's about being relevant, about really spending that time to get that person interested.
I was asked that question, and I want to bring it back to you. IR is communication, and also it's also attracting investments and fundraising. Where would you place it? Is it in the corporate communication, public relations, or it should be standalone, reporting to finance? I mean, what would be the best practice? Because in Arabic, I said it should be, it's going more toward finance and that animal in the company. What would your answer be?
I would say it tends to be more part of a finance brief if looking at the investors per se. I think the investor relations process is much more finance orientated. I think beyond just meeting the chief executive, the next conversations that tend to happen between an institution and an analyst with a company tends to be with the finance director, because they have to get the modelling of that business right. And it's much better to go straight to the person who's running the numbers than necessarily the person who's overlooking the strategy. Because you've already got the strategy, you've already heard the strategy, it's then going down to those parts. So the continuity of communication tends to be through the finance part. Now, it doesn't necessarily, one size does not fit all. I've alluded to in this presentation that investor relations is merging more and more with corporate communications. It's all, everything is becoming the whole. It's just one part of the overall entity. What that brand or what that reputation, that credibility of that company is in the eyes of the capital markets. So some could say it comes out of a marketing budget, because at the end of the day, management are running around various capital markets, racking up hotel bills and whatever, and they can assume that goes into a marketing cost. But personally, I think it's more of a finance function than a marketing one, if you're taking it seriously.
I would like to say something about this particular issue, especially that I tried to be reporting the PR directorate and finance in my career life. If we look at IR, it presents data as facts. It's very solid and dry. It tells the story from the perspective of facts, finance data, to reflect the photo, the picture of the company, the internal picture to the shareholders. So we have to be honest with them, we have to be responsive and proactive. It's much of trustworthy relationship building. However, the PR is much more, I think, manipulative sometimes.
Imaginative.
In a positive way. Sometimes has to deal with marketing more and to reflect an artificial picture more than investor relations, which has to do with facts only. Like if we're passing through a crisis, in the investor relations perspective, we have to be very factual, and as every speaker has said today, we have to be very honest. However, from the PR perspective, no, we have to sometimes make a white lie. We have to sometimes conceal facts. Yeah, until we reach what we want from the stakeholders, which include the shareholders sometimes, and which include our suppliers, our competitors, maybe. So the PR has to do with witty actions more than the investor relations, who have to be dealing with finance as an equation, maybe?
Sure. Putting the first part of the question first, the PR aspect, or even the corporate PR aspect, with investor relations is merging more into the same bucket. In that, if you were to, using your expression, provide a white lie or something which isn't quite the truth, that used to be fine in days of old. But now with the immediacy of media that's out there, and if anything is queried and proven that fact is not a fact, it goes back to what I was saying earlier on with social media. Before you know it, you've got an almighty crisis on your hands, which will need not just the spin doctors, it will also need the investor relations people talking exactly the same message to the institutions to clarify that situation. It's about working together on that, and when putting together, for instance, I put some emphasis on the preparation prior to a roadshow. That is exactly when marketing does need to come together with investor relations to make sure that you've got a consistent story, no matter however it's sliced and diced and interrogated. And that is the really important aspect now in this era of disintegrated media. Great. Thank you very much. Thank you very much.
شكرا سيد بوبي، والشكر موصول لكم أيها السادة والسيدات المحترمين كلهم مع حفظ الألقاب. والشكر كل الشكر للقائمين على دعم هذا اللقاء ممثلين بالفرع الفلسطيني لجمعية علاقات المستثمرين الشرق الأوسط، كما ونتوجه بالشكر أيضا إلى الجمعية الأم الحاضنة لهذا اللقاء وربطه بخير خبرائها في مجال علاقات المستثمرين، كما ولن ننسى شكر القائمين على إعداد هذا المؤتمر وتنظيمه. إلى هنا ينتهي لقاؤنا اليوم على أمل تجدده في ظل واقع أجمل وأفضل. نكرر شكرنا لكم وندعوكم لتناول الغداء في مطعم الرواق. شكرا للجميع.